Hi guys, welcome to Money by Sunny. Today, we'll be talking about emergency funds. You may have heard of them. This is basically money that you have stashed away for rainy days or to tide you over during unexpected events in your life. Think of it as a financial safety net for you and your family to handle unforeseen incidents that will inevitably crop up from time to time. Why do you need one, and what is it for? No matter how closely you plan your budget or your expenses, it's impossible to look into the future and foresee every single event. Uncertainty is just a fact of life and can't be eliminated completely. The best we can do is to be prepared so that you minimize the impact of these unexpected occurrences. Some typical instances of emergencies where your emergency fund will need to be utilized pretty much on an immediate basis are: Number 1. Household items breaking down. This could be items like must-have electrical appliances, such as your refrigerator or cooker. Number 2. Structural household items. For example, leaky roofing, faulty heaters or air conditioning, faulty plumbing, etc. Number 3. Loss of employment. This is unfortunately something that became more severe during the pandemic, with many companies cutting back. But it's also applicable during normal times, as employment is never a sure thing. Your emergency fund will at least give you some breathing space while you look for something new. As we are all aware, these are very common issues which nonetheless can make our lives uncomfortable if not dealt with quickly. Another possible use of an emergency fund is to help with a down payment for a large purchase, such as a car or a house. In the case of a car, it could make the difference between even taking a loan or paying for the car in cash. This type of expense doesn't exactly fit the emergency label, but it will save you some future interest payments. And it's always good to stay debt-free, or at least keep your personal debt to as low a level as possible. However, you may only want to consider using part of your emergency fund for this reason, and only if your account is already sizable. After all, you shouldn't lose sight of the primary reason for the fund, which is to tide you over when the unexpected happens. How big should the fund be? The general rule of thumb is that your emergency fund should be enough to cover 3 to 6 months worth of your must-have expenses. If you already have a monthly budget set up, it'll be easy to calculate how much this 3 to 6 months figure should be. You should look at only your essential expenses and not include items that are more discretionary or luxury type expenses. For example, your loan repayments, insurance premiums, and essential groceries should be included in this calculation, but not items such as fashion or gadget purchases. The larger you can make your emergency fund, the larger buffer you have, and the better protected you'll be when disaster strikes. How do you build an emergency fund? We've talked about why you need an emergency fund and how much you should have in it. Now, how do you go about accumulating that cash? Like most things, it's best to start small. Look at your monthly budget and identify how much you can afford to put away each month. And from there, you'll be able to work out how long it'll take you to reach your emergency fund goal that we spoke about earlier. A good way to make this happen and enforce discipline is to set up an auto debit from your regular account to your emergency fund every month. Then try to gradually increase the amount that you set aside each month, which will help you achieve your goal faster. How long should you target to build your emergency fund? This varies from person to person, and there is no one answer. But given that you want this to consist of 3 to 6 months worth of expenses, it's certainly not a trivial amount or something that you can build overnight. Try to set a target of a year to accumulate this and see if that is feasible. Don't worry if it takes longer. The important thing is to get started and keep at it. Another way is to consider taking up a temporary part-time job or a side hustle as a means to save up for your emergency fund, if this is possible. This will help you reach your target earlier. Where should you put your emergency fund? Emergencies are by definition unexpected events that tend to need a pretty immediate response. Because of this, your emergency cash needs to be readily accessible so that you don't have to spend days or even more withdrawing it. Now, this doesn't mean that your emergency fund should consist of cash sitting under your mattress. It just needs to be liquid enough for you to be able to access it quickly and easily. At the same time, you want to be able to grow it while it's being stashed away, so that its value doesn't diminish too much over time due to inflation, which can be 2 to 3%. Because of this, a good place for an emergency fund is a high-yield savings account. It's important for your emergency fund to be in a separate account from your regular checking or current account, so that it's easy to see at a glance how much you have, and to also avoid the temptation of spending it. In a separate, dedicated savings account, your money can be easily withdrawn or transferred when it's needed. But it's still earning some interest, so it's not completely idle. Some banks offer higher interest for accounts that are opened online, so that's another option worth considering. Just note that you'll probably want an ATM or debit card for easy cash withdrawals, which some online-only accounts may not provide or may incur an additional fee. If you have an offset mortgage, sometimes also referred to as a flexi mortgage, this is also a great place to park your emergency fund. These don't really exist in the US due to tax laws, but are popular in many other countries worldwide. Offset mortgages have a savings account linked to it, whose balance is then subtracted from the principal of the mortgage. For example, if your offset mortgage principal is $220,000, but you have $20,000 sitting in a linked savings account, the interest on your mortgage will be calculated based on $200,000, which is $220,000 less $20,000. This is a very good option, as you'll get to save the interest on your mortgage. And this interest will very likely actually be higher than the interest rate that banks will pay on savings accounts. All this while keeping your money easily accessible when it's needed. Should you have your emergency fund invested in stocks? The short answer is no, due to the following reasons. Number 1, stocks are not that liquid. Selling stocks to access your cash could take a couple of days, which you may not be able to afford in some emergencies. Number 2, investing in stocks is inherently risky. You might incur short-term losses to your emergency fund, which is definitely not something you want. This is especially so if you're forced to access your funds and therefore sell your stocks in a down market. Having said this, stocks can offer better returns than savings accounts in the long run, and are a good way to compensate for inflation. Again though, this is in the long run, and there's absolutely no telling when you might need to access your emergency fund. You might only want to consider investing part of your emergency fund into stocks if you have a pretty large stash of emergency money. The bulk of it should still go into a savings account that is liquid and more easily accessible. Some people use their credit card as their emergency fund, which is not the best solution, to be honest. Credit card interest is very high, and you could easily find yourself in a debt hole. If you didn't have enough cash to afford to pay for the emergency in the first place, that amount will now be sitting on your card as an outstanding balance, accruing interest every month. You may have managed to cover the emergency, but you'll now have to contend with paying down the balance while servicing the interest. It's much better to save regularly and build up your emergency fund in the first instance. In conclusion, Having an emergency fund is one of the most important steps you can take to achieve financial wellness, and is a must-have for everyone. Once you've identified how much you need, it's a matter of getting started with those monthly deductions. These should be directed into a liquid high-yield savings or offset mortgage account so that this fund gradually accumulates. Knowing that you have this financial safety net will do wonders for your peace of mind and is well worth the initial effort. I hope you got some useful insights from this video. That's it for this episode, and see you next time on Money by Sunny.